Guys, welcome. So, Paul, you point out October has a reputation for being the month of market bottoms, but in order for the market to bottom, it has to go down first. The question is how much, because it went down a bit today. Can you buy these dips?
Yeah, I mean, I think 1% in the market that we've had, where we're up well over 20% on the year, I don't think that's necessarily something to get too excited about. But, John, to your point, you were talking about increased volatility. We have, the geopolitical situation, which is the hottest it's been in years. We have an election coming up in November, and then we have the hurricane down south. I think the election and the hurricane, as far as the market is concerned, are short-term events. Whereas the geopolitical situation, who knows? I mean, I don't know how that is going to end up panning out. So that is a worry to think about. But we do think we just put out our quarterly pros and cons report this past Friday, and there's plenty of positives to like still about the market here. And we do think if you do see a 5% pullback in the market, 5% pullbacks are more common in the month of October than any other month. We would be using that to add exposure. So in that respect, you do have to see weakness in October to get a bottom, and we wouldn't surprise us. In prior years, when you've been up 20% through the first 3 quarters of the year, October has been negative 7 out of 10 times, but the fourth quarter tends to be positive.
Jose, I get the impression from you that you might not need a pullback to see things attractive about this market. You say the fundamentals are good, Fed cuts are good for risk assets. Do you need to wait for a pullback to buy?
I think Paul, he brings up some great points, but no, we're still positive. We're still bullish on the market long term. Fundamentals look solid. Look at the disinflation we continue to see. We should get more of that later this week. So if you have continued disinflation, wage is still rising at a good clip. Remember, inflation has fallen a lot more than wages. The consumer continues to be one of the drivers of economic growth. That's always been the case here. And we expect that consumers are looking for value. But the good news is the corporate sector has heard that alarm, and they are you're seeing discounting all over the place. So I think you'll see more of that. And I think that'll keep us afloat and longer. Remember, we still have the tech revolution that it's just at its inception. So from our perspective, the fundamentals look pretty good. And that tech deflation, which is something that happens, we saw this happen in 94 to 2001. That has not yet kicked in. And I think we're going to see that kick in more and more.
Yeah, something definitely to watch here. Paul, we got yields up. We got oil up. Equities are taking their cues from some of these other asset classes. Oh, the VIX up as well. Equities are taking their cue from some of these other asset classes, at least here in the near term. So how much actually has to go right for earnings season for that to actually become the driving catalyst and the narrative for stocks from here?
Yes, you bring up a great point, Morgan. Earnings season kicks off at the end of this week with the financials reporting. When you look at individual analyst revisions on companies within the S&P 1500, we've actually seen over the last 4 weeks a steady uptick in downward revisions to earnings estimates. So when you talk about complacency heading into earnings season, analysts have been lowering forecasts. And what you tend to see during those periods is it sets the bar low for earnings season, and then companies tend to do better. So when you have more negative revisions than positive revisions heading up to earnings season, you tend to see gains during the 6-week reporting period that we measure. And at levels that we've seen heading into this earnings season, the median gain of the S&P 500 has been low to mid single digits. So bar set low, so it's easy for companies to surpass that level. And some of the sectors where the revision spread are pretty negative here are in technology, believe it or not, energy and industrials.
Jose, the big story for the market today really was what we're seeing in yields, and not just the 10-year yield back at 4%, but also the 2-year yield flirting with that, and the fact that you have the yield curve, flattening out again here. Because we do have financials kicking off earnings later this week, and because we are seeing this volatility in the bond market, how do you think about that as an investor? Does it mean that you look to fixed income as a bigger part of the portfolio? Is this something that's going to be short-lived?
No, I think if you look at when the Fed starts to cut rates, Morgan, the next 12 months, fixed income does very well. High yield does well, but investment grade does even better. So we like fixed income. We're telling clients to extend duration and look for quality credits. And we also, if you look historically, especially when you go into mid-cycle slowdown or a no landing scenario, you see that U.S. markets do very well. So does EM Asia. So we're looking for credit opportunities there as well, in particular India. And then I think if you look at the equity markets, as the Fed rings the bell, begins to ease, one sector we haven't talked about is healthcare. And healthcare, you're not seeing the same level of revisions as was just mentioned, downward revisions. And if you look at earnings expectations for next year, it's the best sector out there. So we still stay positive on that one. And historically, that has done very well when the Fed eases. So healthcare, we still keep our eye on that one. And I think one of you mentioned before that energy story, as utilities have done well, and they were a little overbought. The other thing is growth in value, right? We're again at a 2-to-1 ratio in growth in value year to date. Look for some of that to, I think you're going to see some mean reversion there. That's going to give us that volatility that we're both looking for to get that end of year rally where we can get between 40 and 60% of the year's returns. So hopefully we get a good year end rally out of it.